Hey guys, and welcome to the fifth episode of Daily Dose of Finance. Just woke up, as you might hear or see. Just woke up from night shift. We're gonna do the third part of Peter Lynch today, of the video we were looking at. Yesterday we went through that he wanted to own companies that could be run by not that intelligent people, or run it badly, and that the management was kind of the icing on the cake. And he pulled the example of Toys R Us, for example. He also talked about that a lot of this is not crazy math or anything like that. It's grade math. We don't talk about algebra and that kind of stuff when we do investing. So yeah, and that a company that earns a good amount of money and has no debt should not go bankrupt in that sense. I pulled up Opera here today. It's over our 1,000-day moving, like exponential moving average. But it looks kind of interesting, and it's also actually a Norwegian company founded in 1995. I did not know actually. It's not on the Norwegian stock market, which is a shame for me. But it is on the Nasdaq. We can see that it looks pretty good. Like EPS growth should be around 15 to, or well, around 20% a year for the next coming years. I'm gonna get better numbers when I have subscribers to Seeking Alpha. They also have, well, we will get even more outlook for the numbers or estimates. They also have estimated about 15% growth in revenue. And if we look at their capital structure, the company right now is worth about 1.4 billion. It has about 10 million in debt and about 126 million in cash. So I would deem it's pretty good, having over 10 times the amount of cash compared to debt. And also not being a crazy market cap or anything like that. With this EPS growth and with the revenue sales, the PE is pretty good. It's very good actually. So might make another video for this in the future. But yeah, let's that's enough talking again. Let's jump into the Peter Lynch video.
Okay, now we'll get to the important stuff. There's always something to worry about. This is the difference. This is what happens in the stock market. Because, see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about. I went to school, grew up with a kid in the 50s. In the decade of the 50s, there's this big theory that the Depression was caused by a stock market crash. Totally wrong. Less than 1% of Americans owned stocks in '29. We had this big time recession. In fact, it was a depression. That's what, it wasn't caused by the stock market. The economy went down, the Federal Reserve raised interest rates, and we had a big time depression. In fact, we had several depressions like that from 1850 on. This was only one of about 8 depressions since 1850. But people thought the only reason we got out of the depression was World War II, and they said once we get back, next time we have a recession, we're going to have a depression. And it's going to be a great depression. I never understood that adjective in front of depression. Now, you ought to be crummy depression or bad depression, but it was a great depression. I never quite understood that one. So people weren't buying stocks in the 50s because they thought that another great depression was going to happen. In addition, people were very scared about nuclear warheads and nuclear war in the 50s. People were building fallout shelters, stocking canned goods. There's something about going to Vermont, building a fallout shelter, putting canned goods in it, that you don't buy Minnesota Mining or you don't buy Eastman Kodak. I mean, the syllogism just doesn't work out, that you're buying lots of water, buying a shotgun, buying frozen food that will stay in the freezer with your own generator, and you're looking at growth stocks. Doesn't seem to work out that way, you know. And I remember in the 50s, I mean, I remember literally in classes, I was in elementary school in the 50s, and they'd come in, they'd have one of these air raid drills, somebody in a yellow hat would come and they'd blow a whistle, and you'd get under your desk. Even then I says, I don't think this is going to do a lot of good. You know, but people are worried about a depression in nuclear war in the 50s. They're on the left side, though. Every one of these little countries has enough warheads to blow the world up 88 times. Right? Who's built a fallout shelter there? You know, we stopped worrying about it. I mean, there's always something to worry about. In the 50s, it was depression and nuclear war. The 50s was the best decade this century for the stock market, except for the 80s. Only slightly better. The 80s were only slightly better. People didn't expect a lot. We had an okay, it wasn't a great decade. They just didn't expect much. We made it through. And the stock market was terrific. Do you remember when oil went from 4 to 40? Remember that period? Oil went from 4 to 40, and the experts said it was going to go to 100, and all the countries of the world were going to go bankrupt. And then the big banks were going to go bankrupt, and we're going to have a Great Depression, and the stock market was going down, and you're going to wind up selling pencils and apples. You know, well, I remember when oil went from 4 to 40, and the experts said it was going to go to 100. Within 2 years, oil was at 14. The experts, now much higher paid at this point, are saying it's going to go to 4, and we're going to have a depression. And people believed it again. You know, I remember when the money supply was growing too fast, and they said we're going to have a depression. Then it was growing too slow. We're going to have a depression. Remember the LDC debt? Remember the LDC debt? All the banks. Our banks are very smart. They lend all their net worth to Zimbabwe and Botswana and Botswana and all these countries. Chile, a lot of countries they can't pronounce. This is Chase Manhattan and Chemical that manufactures Hanover. These countries weren't doing so well. Then they were called undeveloped countries or less developed countries. Now you have to call them emerging countries. It's not politically correct to call anybody an undeveloped country. It's like I just found out the other day the term for somebody that's overweight is laterally challenged. You have to say something laterally challenged. But these were LDC debt. They were all going to go bankrupt, and we're going to have a depression. Then the Mideast was going on in the world. Remember that one? The Mideast was going on in the world. They weren't going to buy our bonds, and the market crashed, and we're going to have a depression. Then Japan was going on in the world. Remember that one? Japan was going to have all the assets, and they weren't going to buy our bonds, and we're going to have a depression. Within 3 years, the Nikkei Dow had gone from 40,000 to 16,000. The banking system was in trouble, and people said Japan was going to collapse, and we're going to have a depression. I mean, people had, on their prayer list, at the end of the day, they had eliminate crippled children and Mother Teresa. They're praying for Japan. I mean, you know, it's a country with a 15% savings rate. You know, it's something bizarre. You know, commercial real estate, global warming. You know, and I think as the older you get, the more nervous you get about these things. I think it's very valuable. I think while younger people are better investors, is they're not worried. They haven't heard about all these crises. And they're with children. I think if you don't have any kids, you got to rent some kids for the weekend. You know, get a 7-year-old and ask him if he knows about the money supply, you know, how fast it's growing. Ask him if he knows about the shape of the yield curve is the wrong shape of the yield curve. Or that we're 48.3 months into the economic recovery and the average recovery lasts 52.3 months. You know, ask an 8-year-old if they know about that. 8-year-olds have a very high expectation about the next 20 years. That's what you need to do. The more you get away from 8-year-olds, the more you get away from 11-year-olds, the more you start reading these crazy things you read over the weekend. In fact, from 1955 to 1985, the stock market went up a grand total of 1,000 points, but it was down 800 on Mondays. So it was therefore up 1,800 on non-Mondays. It wasn't an accident. The stock market went down October the 19th, 87 was a Monday. People over the weekend become economists and portfolio strategists. You know. I mean, they're a bull if they take their lunch on the way to work. You know, in fact, I knew very well the market was going to go down in October of 1987. Dave Elson remembers that. It was my first vacation I was going to take in 6 years. And we decided to go to Ireland, and we're going to stay at all these little cottages and play golf. And I left on Thursday after the close of trade. The market was down 55 points, which wasn't a good start, but it was down 55 points. And we got over there, and because of the time zone, we were able to do what we wanted to do and get down to Cork, and called in the market was down about 118. And I said to Carolyn, if the market goes down on Monday, we better go back. But we're already here, so I was to stay for the weekend. So as you know, the market went down 508 on Monday, so I flew home. Because my fund had gone, from, I think, from 13 billion to 9 billion in 2 working days, and it was the trend here is not positive. Like I could do something about it, you know. But there's time when they called, they wanted to say, well, what's Lynch doing right now? Well, he's on the 10th hole. He's even part of the front 9, but you know, he's in a trap right now. This could be a double bogey. This could be a quadruple bogey right here. Could blow the entire front 9 right here. You know, this is not what they wanted to hear. You know, so I have no idea when the market's going to go down, and No idea when it's going to go up. I'm totally shocked. The market was 4,000 2.5 years ago. A little while ago, it's 8,000. I had no idea about this. Very surprising to me. But I'll guarantee you the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. And if somebody in this room knows about it, they're not telling anybody. Or they're not in this room. They're down in Palm Springs somewhere. You know, they've made $1 billion. Or if they know anything about interest rates. Because in interest rates, if you can be right 5 times in a row in 10 grand, you can have $2 billion. There's not that many people with $2 billion. There's a lot of people predicting interest rates. Did you ever think about that one? Just 5 times right in a row in 10 grand, $2 billion. If you write 7 times in a row, you can have the GNP of, you know, the United Kingdom. You know, it's a big number. So I don't worry about that. I know we've had 96 years of century, and the market's fallen 53 times. We've had 53 declines of 10% or more. So 53 declines in 96 years. Once every 2 years, we have a 10% decline. Of the 53 declines, 15 have been 25% or more. So 15 in 96 years, about once every 6 years, the market falls 25% or more. That's what we call a bear market, you know that. And it's going to happen. I don't care when it's going to happen. I would love to know. Obviously, it would be very useful to know when it's going to happen. It doesn't make a difference to me. Corporate profits will be a lot higher 8 years from now, a lot higher 16 years from now, a lot higher 30 years from now. That's what I deal with. And I'll be glad to answer your questions. It's great. Enjoyed it. And I want to start the questions.
Hey guys, and welcome back from the Peter Lynch video. I think it was great. And he has some great points. We're gonna watch the Q&A later tomorrow. So that's gonna be also a great time. He started talking in this video about the fears of recession or depression. It was always interesting that they named it the Great Depression, which I found funny. And they always talked about like nuclear war, oil prices, and for example Japan rising, right? He also talked about and was emphasizing the long-term market growth, right? Like he doesn't know what the market is gonna do the next year there again, maybe the next 3 years, he don't know. But he knows that in 15 or 20 years the market is going to be higher than it is today. So it's quite interesting, right? And also that in 96 years we have had 53 declines, 15 of them has been bear markets, right? And he also shared that story from 1987, sorry about the sound. And in 1987, that was about that he was out golfing and he didn't predict the crash, right? But he just highlighted that story for the unpredictability, right? Then I had to pull up the S&P chart for this, and we all know in here that we have the bad time we all had with the contagious thing that sent the market into kind of a crazy crash, right? Then we recovered, and that was about almost 40%. Then we had a decline in 2022 all the way down to about 27%. Then we had another little leg down in 24, 10%, and currently we are doing about 10%. Are we going down to kiss this line on the 1000-day EMA now? Don't know. Gonna be interesting. But in all this time, that is not that far, but 5 years, we have done about 180% or so. That is pretty crazy. So I think we have to. The key takeaway from today's video is that you don't know what's gonna happen in the stock market for the next 2-3 years, but if you're investing for the next 15-20 in great companies, it's gonna do greatly. So, but that's enough talking for today. I hope you have a great day. go out, enjoy the weather, and I see you tomorrow.